First of all, very good morning, and I welcome all our participants to this live session, and then all the participants who have joined this virtually, and then very eager to hear views and outlook of our expert panelists here who have joined to discuss a very hot topic, which is about redesigning India's financial experience. So again, I welcome my co-panelists here. Shashank, Anubhav, Manish, and Sudhesh. Welcome again. The panel that I have today is the center of banking, financial services, investments, payments, digital consumer lending. I think whatever is happening in India for the last decade, and then these panelists have been at the center of digital lending and everything, and then leading the next decade, which is about debt ecosystem in the country itself. So that's the reason why I think this high-powered expert panel is, we have them ready to share their views without without any ado. We think we can go live. So my first lead question is to Sashank. Sashank, given that you've been through this, over the last decade, and then seen the opportunity that is out there, and been through the thick and thin, there are a lot of learnings, and still there is a significant opportunity out there. So if you could summarize your learnings, and also paint your outlook for digital and consumer lending in India, and then how you see this specifically for consumer lending, and also beyond consumer lending in MSME space as well.
Thanks, Irfan, and thanks a lot to you and the whole team at Yubi to have me here. It's a pleasure to participate in this conference today. Before I jump into the meat of your question, I think it's helpful to take a step back and just re-articulate what we're all trying to solve for, right? And which comes down to the fundamental role of credit in the economy. If we put aside all the talk around kind of UI, UX, user experience, etc., there's a very simple fact, which is why we're all here. And that is that India is looking to get to a $5 trillion economy very quickly. And now there's talk of building it into a $30 trillion economy over the next couple of decades. This is an amazing goal, right? And it's incredibly ambitious. But no country in the history of the world has achieved this kind of growth in such a short span of time without a concurrent expansion in retail credit, right? In fact, retail credit has to grow at least twice the rate of GDP growth for such an expansion to happen. Yet at the same time, we have a complicated relationship with credit as a country, right? We have, and I think that's where, in my mind, the problem statement of fintech began and needs to continuously come back to, right? And so the question for us entrepreneurs becomes, how do you, in some ways, kind of change this culture by creating products that can serve people, the vast majority who are not well served by the banking system today? And how do you do it in a manner that is sustainable, responsible, and empowering for them, right? And so then if you think about it that way, the challenge becomes twofold. It becomes one around scale, right? How do you find these customers who aren't well served by the banking sector? We have the lowest credit card penetration in the world. We have 200 million people who actively shop online today but don't have an unsecured credit product of any sort. How do you find them and serve them effectively? And then the second question becomes, how do you do this sustainably, right? How do you manage risk? How do you ensure discipline in underwriting and collections? How do you ensure these customers don't get over leveraged? And how do you build products that give them the ability to build good credit habits over time and use credit as a tool for their own advancement rather than a trap, which is what we've sometimes seen in the past, right? So I think that has been the journey, and that journey doesn't happen overnight. I think it happens through being at it and having the right North Star metrics, and most importantly, working through cycles. And I think we have in India been fortunate or unfortunate to go through a series of macro events over the last few years. And so I personally am a lot more optimistic about the prospects of fintech in cracking this big, hairy national challenge, simply because we have been through the good times and the tough times to build the resilience that is needed for such models.
Thanks, Sashank, for that response. I think pertinent points that you made around scale and India's interesting relationship with credit, and how do we do this responsibly, of course, underlying the opportunity that we have ahead of us. Manish, I would turn to you, given your experience in traditional banking. You've seen SME, vehicle, that asset size and assets classes, and then subsequently have been a thick and thin of fintech, and now also taking care of a large NBFC's aspirations around digital lending across. So, given that experience, the last decade has been really defining with events like Sashank touched upon, Demon to multiple, crisis, and then recently COVID. So, given that journey, and then the way you have been leading, what you have been leading at your organization and previously, how do you see this panning out, and your experience and outlook here, please?
Thanks, Irfan. Yeah, I think this has been an interesting journey. Last decade has been really interesting for everyone. For the entire ecosystem, not just to say for players who want to kind of introduce and get new things going, but also from customers' perspective, from the regulator perspective. I think the last decade, I would say, has been the decade of evolution for everyone in the financial industry. The way I look at it, there are 3-4 things which have been kind of moving around, and which everybody is getting, is trying to solve for or is getting impacted with. So one is, of course, as Sashank rightly put it, in terms of saying, how do we serve the underserved? The inclusion aspect has been something which has been really a big one. I think while inclusion has been something which is talked about, I think that another big piece, which alongside the inclusion side is happening, is the further penetration in already, which are, the segment which is already inclusive in terms of financial services. I think penetration has actually kind of increased over the last decade. And third, and the most critical for any financial services ecosystem, is going to be the quality. And that's where the quality focus has actually come in. If you really look at it, while evolution happens, and there will be certain slippages that will happen, but over a period of time, without the quality aspect being there, the long-term sustainability is not there in any ecosystem. So I think these are the 3 aspects which we have been seeing have been growing in the entire ecosystem and will continue to flourish, as we move forward. I think, as you rightly said, having seen the ecosystem from various sides, first as a traditional lender, then probably as somebody who was working on the fintech side of it, then working alongside fintechs, collaborating with them, and trying to build a big balance sheet of our own through that collaboration mode. I think there is one important thing which is happening, and which is going to be the theme for next at least 3 to 4 years, the way I look at it. It's going to be, of doing more and then passing it on to the next stage. I think that is what we are going to see happening now. All the things that we see, directionally are moving in that way. So for example, when we look at co-lending, that's a way of do your bit and then pass it on to the next level. The way we look at co-branding on certain sites, that is again nothing but another way of saying, you do your part and then you pass it on to the next. Because the market is such a large one and it's an open tap. The more you actually kind of explore it, the market kind of keeps expanding, and that's where you see, the rate at which we grow is not the rate at which the penetration happens, right? So the penetration rate is much lower than the rate of growth of any of the companies, whether it's fintechs, whether it's NBFCs. And so that's an important trend, I think, which we all need to be kind of cognizant of, and understand that there's enough and more for everybody in this ecosystem, provided we kind of remain true to what we want to solve for, and do it in the best manner. I think another trend that I personally see, Irfan, here going ahead, is going to be a very thin line between the credit and the debt products that we see now, and that I'm talking from a fintech side of it. As we collaborate more with the fintech ecosystem, it's not just going to be the credit which is going to be there. I think the debt ecosystem is going to be becoming even stronger, and the debt instruments will actually come and play a huge role for this market to evolve, and to continuously evolve. Otherwise, just the capital side of it may not solve for all the problems that we are looking at. So I think, in a nutshell, I would say, a lot of evolution. I think from competition to collaboration, that's the way we are moving now. And even on the collaboration side of it, I think now it's going to be, a healthy collaboration, which I call it, with the regulator also coming in and putting in the right framework for collaboration to thrive. I think with those kind of steps that have been taken in the ecosystem, I think there's going to be a huge amount of controlled growth that we are going to see, and which is going to be more sustainable than ever before.
Thank you so much, Manish. I think you actually summed up the decade in terms of how it went and then how it is also going to be. Also, you touched upon something about beyond credit. You touched upon about debt ecosystem, debt instruments, regulators, customers, and penetration. Very, very pertinent points. I'll come back to that. I would like to go to Anubhav and then touch upon his experience, especially around payments ecosystem, because what definitely has triggered at least the last 5 odd years is the evolution the payments ecosystem has seen, and how that has impacted the financial services industry as such, and the blend between tech and finance. That's one. And then we are going closer to what we call embedded finance. There's a extremely that's a topic which is close to probably Anubhav's experience, and then he would like to throw some this. Number two, along with that, Anubhav, I would also like to talk you to also talk about how do we scale this, which is embedded finance, and scale this responsibly, because both Sashank and Manish talked about doing this sustainably, right? So if you could touch upon the scale with responsibility. Anubhav, please.
Sure, thanks. So I think Manish and Shashank have already touched upon some of the macro aspects, so I'll not get into that. I'll probably go into specifics. So, if you look at the last decade versus this decade, typically what has happened is we've seen a lot of disruption in India on the consumer tech side, right? We've seen technology helping us change how we lead our lives as an individual, as a consumer, across different things. And financial services has been impacted and has played a big role in all of those. So, to take an example, with smartphones and low-cost internet, consumers have, now started doing things which you could not have imagined can be done online. Ordering food, ordering medicines, booking a cab, taking a loan, taking a credit card, in fact, opening a bank account instantly. So, so across whether financial or non-financial use cases, the whole ecosystem has changed. But what we also need to realize is, for doing a lot of these things, there is a lot that happens at the back end. So when you talk about one transaction which is between a consumer and a business or a financial entity, there are multiple things that are happening at the back end, which we can call it as the infrastructure play. There is a lot of back-end infrastructure. There is a lot of B2B infrastructure that needs to be built around that. In fact, to take a simple example, and this is where probably we can link payments as well. If you talk about the retail ecosystem, right, the commerce ecosystem, as we go and buy a simple thing from a kirana store or from an online marketplace, there are 4 different legs that product has crossed on the B2B side. It has come from the OEM to the brand, from the brand to the distributor, from the distributor to the retailer. And there are 3 different B2B transactions that have happened to enable the consumer to actually get that product, right? So what we believe, and I think that holds true for most of the economies that are growing right now, is that the next decade is going to be all about building B2B and SaaS infrastructure. And that's where SMEs, that's where financial experience for businesses also comes in. Not to say that the retail credit and retail economy won't grow, but I think there's quite a lot of innovation happening, and a couple of my friends on the panel are actually leading some of those innovations in the market. But when it comes to B2B, that has largely remained broken, and that has largely remained human intensive in the past. Technologies get to penetrate B2B transactions, and B2B transaction world, whether you talk about payments or whether you talk about credit, is 4x of the consumer or the retail world, right? So what we believe is, I think, as we go deeper into the B2B transaction world, one thing is clear: businesses transact with businesses on a daily basis, and to do those transactions, they always use credit. I mean, credit is integral to a B2B transaction. It's hardly it hardly happens that a business transacts with another business and they pay for their product or services upfront. You know, a typical B2B transaction involves a purchase order, an invoice, some payment terms, which could be 30, 60, 90 days, right? So credit becomes very, very critical to run the B2B economy. And I think because this is integral to the transaction, what needs to happen is we need to change the way we look at that B2B transaction credit. It's more a payments instrument, because all I'm asking as an SME is, hey, I'm consuming a certain service, I'm procuring certain inventory, I'm procuring certain supplies. There is a certain cycle in which I run my business. Can I pay for this after 30 days or 60 days? Right? Which is very common. Now, if you say that I'm taking a loan to do this, then I'm running my business on a loan, which is not true. Right? So this is just a payments instrument I'm using to power my transactions. And this keeps on happening, right? It's bread and butter, it's part and parcel of B2B economy. So I think as founders, as well as players in the ecosystem, what we need to do is, when we now look at B2B empowerment and SME financial inclusion, we need to start looking at the use cases more outside of credit, right? That will really change how you create an experience. So if today I am empowering a transaction between a retailer and distributor, if I look at it like a lending use case, I'm going to optimize for different metrics. My North Star will be different. But the moment I see this as a repeat every week transaction, and I look at it as a payments instrument, of course, there is credit being used to power this transaction. But if I look at it like a payments instrument, then the kind of metrics I'm going to be optimizing for as my North Star metrics are going to be different. And the experience you create in the latter case will be completely different. So the scale that you talked about and the embedded finance use case actually comes into picture here, because when we talk about B2B, I think it's very important that financial experience become a part of the transaction. It's happening in consumer as well, Irfan. Like, for example, when we book a cab and if we're going to an airport, we see a missed flight insurance being attached to it. When we book an airline ticket, we book a health and travel insurance attached to it. Right? When we are now trying to buy online on e-commerce, we get a credit instrument attached to it, right? That you can pay in easy EMIs. The same needs to happen across. And for the economy to grow and for you to power small businesses, I think we need to understand these small use cases of businesses and embed financial products inside them, whether it's payments, whether it's credit. And I think credit will always remain core to how you empower transactions for SMEs and for businesses in general. But payments becomes the first use case, because that is where you enable transactions. And with digitization, with UPI and all that, I think we're at the right place at the right time. So there cannot be a better timing for us to have this discussion and for us to solve for this.
Thanks, Anubhav. I think you made a few critical points around B2B, because that is still something which is broken, and then a lot of learnings from consumer to consumer lending to B2B lending, which I think many of us here also are trying to solve and have seen this very, very closely. I now go to Sudhesh, who brings in the other side story and then experience, which Manish also touched about in terms of what is capital solving for, and then there should be a decent supply. And Sudhesh has seen this very, very closely. So Sudhesh, from that perspective, while there is a lot of opportunity in terms of the demand from the consumers, from the enterprises, B2B and all, but the pipe that is going to serve that, be it debt, be it equity or various instruments to be able to fulfill that. Manish also touched about on the other side, but to be able to take care of that demand, what's your if you can throw some perspective there from having looked at this from a financial inclusion perspective, fintech perspective, and also being a banker earlier. Yeah.
Thanks, Irfan, and hi everyone. So before I start, I think maybe in terms of where we are right now on the capital side, I think in terms of sources, in terms of ticket size, in terms of frequency, I think we are a lot better in a lot better situation or position compared to a decade back or two, right? Without getting into the current macro, I mean that's hopefully is a temporary phase. So along with what we want to do, like what Sashank mentioned, Anubhav mentioned, and Manish, the supply to do what we want to do is also very, very critical. And especially in the lending business, depending on whether one wants to play it asset light or asset heavy, the number of sources vary for a company. So if the business is asset heavy, someone would want to tap into multiple sources, multiple innovative sources, as long as they keep the cost of raising that capital within the range that they want it to be. So that's the overarching statement on capital supply, but maybe we can touch upon a few areas on this conversation. To start with equity, which is a critical fuel for any business. But the journey of an equity raise, equity capital tracks very different compared to a leverage solution. So it starts with an idea to a product market fit, and then moves on to looking at modes in the business, cracking the unit economics, and then the growth and the profitability. So typically a company would need capital to move to each of these stages, or when they move from one stage to another stage after having been successful in the previous stage. Seed, pre-series A, series A, and so on and so forth. So this equity forms the bedrock for any fintech business, be it lending or non-lending, on which a debt can be layered in. And consequently, in a lending business, money being raw material, the amount of leverage a business can build on equity becomes very, very critical. And on the debt side, it varies again between on balance sheet and off balance sheet. That depends on whether the company wants to have full stack in-house, or a part of that stack, which is a lending stack, being with some other company, or a mix and match of both. But particularly in a lending business, it becomes important for the company to have a lot of flexibility. And that flexibility comes with having its own NBFC to do a lot of experimentation, be it product, be it customer, be it anything else. Because it might not necessarily fit into the scorecard of another institution. And that journey of an NBFC, like I said earlier, is very different from an equity in itself. And especially when it comes to getting to one from zero on our debt side is critical. That first lender, cracking that first debt is important. But from there on, the journey in general becomes a lot easier. Moving from an NBFC to a bank over a period of time, and within banks, private sector, public sector, multinational banks. Believe me, each of these are milestones, but it far outweighs the efforts and the time that goes into it. But as the company grows, then other market instruments, widening the customer base, even from a liability side, becomes very important. And in that effort, the NCDs, MLDs, listed, unlisted, and even at some point, public issue of debentures, where it creates a brand on the liability side, it also becomes very, very important. But this is all on the balance sheet, so continues to kind of keep the balance sheet heavy. But there has to be a balance in terms of how the off-balance sheet is built, so that instead of, let's say, a 3x or a 4x, it could be a 4x or a 5x kind of a leverage. And that significantly comes through the off-balance sheet partnerships. Where a fintech company can leverage a large NBFC or a bank, which has the advantage in terms of lower cost of capital, but the fintech is able to provide a better experience to the customers, is able to crack a product that wasn't cracked in the past, or is able to widely provide that product to the customers. And that can be leveraged anywhere between 20 to 100% of the entire book, depending on how the customer how the company wants to kind of leverage this. And then there are other things also which makes asset light, like securitization, assignment transactions, and more innovations have come in this piece. Where if the asset maturity itself is lower or the tenor itself is lower, then there can be a persistent securitization. I hope more innovations do come up here, because at the end of the day, every company wants to be asset light. One interesting last point I want to touch is the venture debt, which has come up in the last 10 years. Like I said, every decade has been better when it comes to capital supply. For companies, for founders, it's an effective way of relatively less dilutive debt instrument or funding instrument, which can be used very effectively in between stages of equity capital, or in an economy which is probably having a temporary kind of standstill on the fund flow from an equity side, but venture debt are there to take a bit more risk compared to a traditional debt player. So in order to sum up, this decade, the decade that we are in, has been better, and I really hope that more innovative instruments to come up, and we have a better decade and decades to come in terms of capital supply going forward.
Thanks, Sudhesh. I think you covered on a few very important points about which also, are consistent with what Manish and Shashank were also talking about with respect to you do what you are best at in terms of, and then collaborate with other balance sheets, securitization to co-lending to other pieces, and then a lot of sync across our thoughts. I would actually now take, we have about 8 minutes, but we want to, talk about the other side of disbursement, because experience generally is talked about till disbursement, but how do we talk about post disbursement, be it the process of execution or underwriting, which determines the credit cost, and then post disbursement collection servicing, which is also a critical point, especially in a lending business, which is about collecting that last EMI, and then ensuring that you are able to price that risk. First of all, measure risk, collect risk, and then subsequently do it responsibly. These are all very important points that are there. My request is to Sashank, who was touching upon this, especially around risk collections and how to do it responsibly and sustainably. And Manish also talked about, but Sashank, your views there quickly, please.
Sure, Irfan. It's a big topic to cover in such a short period of time, but I think very quickly, right, we see it in three parts. There's data and how you organize and draw sense of that. There's underwriting, which has to be an iterative process of learning. And then there's collections, which is as important, I would say, as underwriting in India, right? Giving money out is easy, getting it back is the business model. And I think where we have tried to focus is, how do you create an engine that can get better with time and that can learn faster, right? Which is for us been the journey of starting out with low NPAs, seeing those go up to 4-5%, seeing them now come back down to about 1% stably, even as we grow quickly, right? And I think that comes from two things. The first is having a very structured approach to learning and scaling. And then the second is having the right organizational culture around credit risk, right? And the right safeguards, both at an operating team level, but even at a governance board level. And I think it's the combination of these, without delving into any of these in particular detail, that really starts to create not just mature risk management, but also the foundations of a financial institution, which is what we're all trying to create here for the long run.
Thank you for that quick, response. My request is to Manish, also here, because he touched upon regulations as well. There is a regulation around how we disburse, how we execute responsibly. Again, ensure that there is enough mitigations around the indebtedness to this population, which is vulnerable otherwise. And then subsequently, the regulations being constructive in terms of driving the entire industry to manage the scale and then sustain that scale as well. Not just about, the penetrations that you talked about, Manish, but if you could touch upon the practices that are evolving around digital collections, because at the end of the day, lending is about collections as well, and probably more about collections than just disbursement. So in the from the perspective of customer and regulations, Manish, if you could throw some light. Sashank did touch about approach and culture. I think that's an important piece, especially being a banker and then leading a large NBFC. How do you see governance structures, compliance as part of your culture and DNA?
Sure. Yeah, Irfan, I think Shank put it rightly. The business that we are into is actually a collections business. You just lend and forget it doesn't really help anyone. So we need to kind of be very cautious about who we are lending to and how we are collecting. I think those two are the pillars on which the institution works. The way I see it is, while there are so many regulations around saying, how do you actually kind of go about executing certain tasks when it comes to collections. I think the best way of looking at it is self-regulation. That's what I feel really differentiates somebody who's doing it responsibly. While there are so many regulations which you will have saying, whether you want to outsource it or not, what are the practices that you want to follow. I think if we are really being customer centric, the best thing is to kind of do a self-regulation and see, how we would want to define an experience for a customer. And that customer experience, I think in the entire pace of actually, in the space of going about and being the topmost lender or the fastest growing lender, we tend to forget and just look at it from an experience perspective, which is onboarding. I think servicing becomes the most important part. And that is where, if you really pick up, banks or NBFCs who've seen cycles, the one who stand out ultimately are the ones where the customer experience has been good. In the short run, you could be actually gaining by doing a market share capture practice. But in the long run, that does not really help. So first, I say is the self-regulation part of it. I think the second, as you put it, in today's environment, when we're moving a lot of our products to digital, how do we use the digital collections infrastructure to kind of give a better experience? I think again, the approach here that we have been following and we've been trying to build in the organization is to transition and transform this in a slow but a steady manner. So customers, while there are customers who are early adopters in terms of the technology, and as Anubhav said, payments is also a driver when it comes to collections, right? So how do you kind of use the payments ecosystem to drive that collection infrastructure in your favor by reducing, with the objective of reducing your cost of collections first, at the same time not compromising on the customer experience. And I think that is where there's a bigger gap which exists, while we talk about lending gaps. And my experience of having, taken over a large listed NBFC, which was catering to the financial inclusion space, and now we are trying to collect those, right? Actually throws up a very interesting challenge for us to kind of reduce the cost of collections by adopting digital means, because otherwise these are customers who are going to pay you in cash, right? So that is where I believe you have to have a consistent strategy, a slow but a steady process, where there is a learning which is given to the customers, and there is there is a reason why they should go into digital payments, right? So actually building that is something which is very critical. A simple example, for example, today what we follow is a customer would typically come to a branch to either make a deposit or to ask for a statement of account. And the way to kind of do away with it is, we are trying to incentivize by saying we're not going to charge you anything if you actually come and contact either my call center or use an app to kind of service yourself. But if you come to a branch, then there's a cost associated with it, right? Those simple things actually kind of help you transform the organization to a more digital space, right? Same way on the payment side of it, we started off with earlier, we had an NACH, then we have an Aadhaar-based NACH now. We started with the pre-printed forms for NACH. And now, technically we moved to almost 90% of our customers actually giving the repayment instruments as a digital NACH. right? So I think that's the way the evolution is going to happen. And it does not stop here. Again, once if the customer actually kind of, let's say, misses out on a payment, then again you need to go back and collect. And that is where you need to give multiple alternatives to the customer to say, pay through either any of the wallets or any of the the UPI or any other means, which is more comfortable from a customer perspective, and which makes it very seamless. So, and that is where we've kind of come out with a payments portal to bring in that experience of collections. I think another important thing, while we all talk about a lot about unsecured funding, when it comes to secured funding, the experience has to be very different. For example, we deal in vehicle loans. The collections does not really end up with the payments. The collections actually end up after you have given an NOC to the customer of saying, he can actually kind of sell off that asset also now, right? So from a customer lifecycle perspective, integrating with the RTOs is also a part of our collection cycle. Because if you can avoid frauds there, if you can have control there, you can very well move into a very different direction. A lot of RTOs have taken that step. The latest one being the Delhi NCR RTO, where we're saying, they've gone in for digitization now. So now you need to be connected through APIs to them to give an issue an NOC. I think that is where collections become important, because ultimately the end of collection cycle is to ensure that you get your payments back. And second is you actually avoid any frauds during that life cycle of getting those payments back. So I think digitization of collections actually helps you serve both the purposes. And that's been our approach so far.
Thank you, Manish. I think was interesting to hear all views. We have a short time. I think last 1 minute to Anubhav and Sudhesh. I would request Anubhav, given what Manish and Shashank mentioned, especially about responsibility, responsible collections, and infrastructure, so on and so forth. What should be our ask from the ecosystem, especially from your experience of embedded finance, and you said B2B is broken. So to put this right in a minute, if you could, summarize your thoughts, what could be your ask from the ecosystem?
Yeah, so I think what we as an ecosystem need to understand, and I think Manish and Shashank rightly put it, when it comes to collections and the intersection of collections with payments, I think what we need to understand is overall financial experience is underrated in India, and better experience helps you avoid adverse selection. So let's be absolutely honest to ourselves. The more friction we add to the customer, you would only get the more credit hungry, the more desperate customers into the funnel. He'll go to every length to complete your journey. The good guys would probably fall off, will probably drop off the journey. So I think what we also need to keep in mind as we build responsible risk and collections frameworks is when we also go take a step back and look at onboarding, how do we create the most frictionless journey so that the good guys, the strong guys don't drop off in the overall ecosystem? I think that's number one. The second is obviously I think collections is integral, and getting the money back is important, but people are embracing technology. I also have two examples where we had a restaurant who was using 7-day credit line, and every night at 11 p.m. they used to take a stock check, and at that time realize, okay, I need to order 50 kgs of oil tomorrow, but I don't have a sufficient credit limit, and they used to make a payment at 11 p.m. Now it is important that instantly that money gets reflected back in their credit, right? Because if it is not, then they are struggling to make the next order. So, while if we have not created the right repayment and collections instruments from a digitization perspective, then we are not really letting people utilize credit the way we want them to. So I think these are 2 points that I have to add. Over to Sudhesh.
Thanks, Anubhav. So quickly, I think the ecosystem in India has been fostering innovation. I just wish that keeps happening. More innovative products, more innovative modes of lending or delivering that service that we have been doing over the last many years. So that the regulator steps in at a time when, and RBI as a regulator has been having this approach that let the innovation not be curbed, let it happen. Let it happen through sandbox or through other means. and then I'll step in to draw the boundaries so that the players can thrive. And I wish that approach keeps growing in the right direction going forward. So that's my wish for the ecosystem. Exactly.
Thank you, gentlemen. I think it was a wonderful discussion and lot of takeaways for all of us. And then we brought in our experience together, and then we're giving very useful insights there. So I hope our participants have taken note of the key learnings and outlook there. Again, thanking all of you, Sashank, Manish, Anubhav, and Sudhesh, for joining the panel, and definitely lots of learning for me as well. Thank you again. Have a good day.
Thanks, everyone.
Thank you.
Thank you.
Bye.